I'm Jeff Mixon, and this is another episode of Civitas Institute's Talk of the State. Joining me are two of Civitas Institute's policy analysts, Max Borders and Brian Balfour. Guys, welcome. Today we're going to talk about the bailout. You've heard a lot of information. You've heard about how this is a failure of the market and a failure of capitalism, and we've got some information you need to know about. So, guys, tell us about the bailout.
Well, I'll start off a little bit, Jeff. As you mentioned, a lot of people are talking about how this is a result of deregulation in financial markets, but really, if you do some research and look into what's been going on the last several years, it's actually a case of overregulation. We have government policies really encouraging low-income and riskier people to get into the home buying market. People that really, quite honestly, shouldn't have any business purchasing a home based on their credit risk and their history and so forth. So really, we have that kind of pushing and creating some artificial demand in the housing market, which helps to increase the housing values. And then, of course, all this, you have the Fed with their really low interest rates and their easy money monetary policy really fueling this crisis as well.
Well, you know, we hear a lot about Wall Street greed led to this. Max, what do you know about this Wall Street greed business?
Well, certainly greed is a human force we all have to deal with, we have to think about. But greed as a discrete phenomenon, greed as a force in our lives, it basically depends. If we want to blame greed for the problem that we're seeing in the United States right now, it's like blaming gravity for someone falling on their behind, even though they've got banana peels on the bottom of their shoes. Really, we need to blame the banana peels, not the gravity. And in the same time, we need to blame government policy or the set of institutions that greedy people are going to operate in, and not greed itself. So, for example, if the government makes it such that government policy lets greed get out of control, say, for example, with Freddie and Fannie, where you have socialized risk and privatized profit, greed, yes, it will run amok. People who will greedily get into homes that they can't pay for as a result of the lax policies. But greed in and of itself is a natural phenomenon. Everybody is out for their own interest to a certain degree. And in free markets tend to punish and reward behavior that is healthy, not unhealthy. And here's an example of where it was unhealthy.
So there was a degree of risk involved, and usually people don't associate their home as being a risky venture. How did this risk from what we traditionally think of as a Wall Street thing, you know, I'm going to risk my money, how did that translate into the housing markets?
Well, after the dot-com bubble burst back in the late 90s, early 2000, investors were really looking for that next asset to invest in to get the high returns. And as I mentioned, with the artificial demand stimulating the housing market based on the easy credit as well, and government incentives and policies really encouraging more and more people to get into homes, that was really kind of the next wave. And there was an incentive structure, as Max was talking about, Fannie and Freddie really was buying up a lot of these risky assets, which when they're not subject to the potential losses, that's really going to skew any of their risk assessment. So they're going to take on more and more risky investments and so forth, and really just the whole any market discipline just really crumbles from that respect.
Yeah, in fact, Brian's right. There was a set of laws, one of which was the Community Reinvestment Act, which the long and short of it is said to people who give mortgages, we need you to give more risky mortgages. In exchange, the government said, but we'll back your play. Well, then now,
so if those mortgages fail,
if those mortgages start to fail, we'll back it, and that's what's happened here in 2008. They're making good on a promise, but this is a promise that the government made to industry whose arm it was twisting to give risky mortgages. No sensible person who expects to make money in the mortgage market is going to give a risky loan. It just doesn't make sense. They have too much to lose. Only if they change the risk calculation by the government saying, yes, but we need to get high-risk people or underserved community into these homes, will they do that. And of course, you get all these instruments like subprime loans, and people go from their tech stocks to their flipping houses in Florida, and we've got a perfect storm.
Interesting. I also think we need to talk about the role that the left played in forcing lenders to use this Community Reinvestment Act. One of the most aggressive ones was a group called Acorn, who would basically blackmail a lender into giving these risky loans. That's what they sought, that's what they got, and we're bearing the fruit of that at the moment.
And it's funny, Jeff, because now what the left is doing is they're absolutely hiding from the policies they helped to implement, and they're standing here and pointing at this crisis and saying, this is the fault of the market.
Right.
And adding on to what you're talking about, it's kind of ironic back when groups like Acorn and various community groups allegedly advocating for low-income housing, or affordable housing, I should say, for low-income folks. Those low-income people, they're labeling them as being underserved because they were not getting these kind of loans to get into houses. But now it seems like because of their kind of blackmailing a lot of the mortgage industry, they've gone from underserved to overserved now, which is purely a result of these kind of community groups pressuring the mortgage industry, and of course with some of the government policies that we talked about.
And so now government is regulating their regulation. Of course, it's always epicycles with government action. They make a mistake, they have to clean up the mess, which causes another problem,
Right.
On and on and on.
Well, let me ask you about this. What happened to Sarbanes-Oxley? Wasn't Sarbanes-Oxley going to clean up risky behavior? It wasn't going to correct negative behavior?
Well, what it did was if you tell people that if they have accounting errors, that they're going to go off in handcuffs, they're absolutely going to take this radioactive debt or do whatever they have to obscure it, get rid of it as you like, and now we're seeing the fruits of that. But it's funny how those on the left and in the media are saying that this was a result of capitalism run amok, and when in actuality the institutions that protect capitalism as being free exchange and risk decided by both parties, that relationship was skewed. So now you've got a situation in which the folks aren't taking responsibility for this, are running and blaming the wrong people. And Sarbanes-Oxley is an example of regulation, not of deregulation. So in fairness to the Bush administration, they should have deregulated, and they didn't. They tried to deregulate Fannie. They tried to regulate Fannie and Freddie, by which I mean get rid of the perverse incentives that caused this, and they couldn't. But beyond that, you cannot call the Bush administration an administration of deregulation. Is simply not true. In fact, Sarbanes-Oxley is proof that it was a regulatory presidency.
Heavily regulated environment. Well, there you have it, some thoughts on the bailout, and we'll speak on these issues further. Check us out on the web at nccivitas.org. I'm Jeff Mixon, and this has been Talk of the State.